You are listening to Keystone's Stock Talk Show, episode 289.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook, and keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
It's great to chat with you again this week. In our Your Stock Our Take segment, I will begin with a viewer question on Kraken Robotics, symbol PNG on the TSX Venture, a marine technology company providing best-in-class, ultra-high-resolution, software-centric sonar and sensors, power systems, and underwater robotic systems for the military and offshore applications. For this past week, the company received a record battery order and clarified details about its new Halifax-based battery manufacturing facility. We take a brief look at the announcements and Kraken's current valuations. Aaron answers a viewer question on Highliner Foods, symbol HLF on the TSX, a leading North American processor and marketer of frozen seafood products, supplying retail and food service markets with a diverse portfolio of value-added seafood offerings. The stock has moved higher after reporting better adjusted earnings in its Q3, and Aaron lets you know why and if it is an opportunity. The third Your Stock Our Take of the week, Brett tackles a viewer question on him and her health, symbol HIMS on the New York Stock Exchange, which operates a telehealth platform that connects consumers to licensed professionals. The stock has performed extremely well over the past year, up 187%, but recently came under pressure after the removal of GLP-1 drugs from the FDA shortage list. Brett will let you know if the drop is an opportunity or a sign of things to come. Last and certainly least, Brennan answers a viewer question on Enterprise Group Inc., symbol E on the TSX, which provides specialized equipment and services used in the build-out of infrastructure for the energy, pipeline, and infrastructure construction industries. The stock has had a great last 12 months, but pulled back recently, and Brennan lets you know if the drop makes Enterprise more attractive today. All right, let's get to the show. We want to welcome my co-host, Mr. Aaron Dunn, the Killer Bees, Brett and Brennan. How are you guys doing?
Doing well.
Pretty good.
Good to hear. Lots of energy there. That's good.
Yeah.
Always, yeah.
The weather's been
Really
nice
good.
in Saskatoon, so I kind of got the spring itch. I'm ready to
Spring
golf.
Oh,
Yeah.
that's good. Yeah,
It's been
well,
nice.
but you're a bit under the weather, or kind of you're
Yeah, I
suffering
got a
from a
migraine right
migraine.
now.
So we should do some real flashes for you to see how that works for you right now.
Yeah, or
I'm
just
sorry,
yell
it's
loud
probably hideous.
noises. Yeah.
I hardly even get headaches, knock on wood. So I don't know the migraine experience. I'm sure it's not fun.
Yeah, it's not fun. Yeah, it's like always like I always get ocular migraines too, so I like lose my vision for like 30 minutes and then like I can't see the screen. I was literally on the
Right.
phone with Ryan and I was like, "Oh no, I'm trying to do my segment right now. I can't see the screen. I'm just writing gibberish right now. I'm going to have to proof it all later. Hopefully I've
Gibberish.
proofed it all correctly." So, yeah.
Yeah.
Should be good. I'm feeling
No
a little bit
different
better
from the
now though.
usual that you provide.
Yeah,
so.
exactly.
Yeah, nobody will know the difference. No, but yeah, speaking of fun, over this past weekend, I got surprised with a birthday party. So I have 4 sisters, and they happened to clip some photos from the internet and put my face on with a sombrero. We had like a Mexican fiesta here, so it was kind of fun. If I think Brett has some pictures he can put up, because everybody really wants to see my face with a sombrero on it. It just
So
they were literally these
family get together. Was this
yeah, all
birthday party?
family. And these were literally all over the house, and they were on cupcakes, these little things. And I even went to bed at night, and there was pictures of me in a sombrero hat, like large, sitting in bed. Now it was kind of disturbing, to be honest, but it was pretty funny. And my sisters texted me and said, "Did you find you in the bed?" I'm like, "Okay, all right, that's enough." But it was pretty funny. So we did that, and yeah, and now we should get the heck into the show. What do you think?
One thing that I
Oh,
would
we have
like
a
to
poll
say,
question. That's
yeah,
right.
and even
Yeah.
before that, sorry, is we've broken 5,000 subscribers on
Oh,
YouTube. So
it's
woohoo.
huge.
Oh wow, that's
Um,
huge. That is
yeah,
huge.
so we should do another giveaway, a mug giveaway. We should
Yeah,
mug
for
somebody.
next week, send your stock, our takes in, and we will send out a mug to the winner. A
Yeah.
mug. Well, you'll get mugged.
Yeah,
That's what we
that's
call
what
it
Ryan's been
on the
calling
show.
it. So
You
yeah,
get mugged. So
that'll
that's
be
what
good.
everybody's looking
Ryan
for.
will give you the mug, but he'll hit you over the head with it and steal your wallet.
At speed. Boom. Okay. Yeah, no. So send that in. 5,000. Very excited. And we'll keep providing the content here. But we do have a poll question, correct?
Yes, we do have a poll question, and it's do you want to be mugged by Ryan? No. So it's
Yes.
how do you expect Trump's drill baby drill oil policies to impact oil stocks? 26% of our viewers said positively impact, 36% said no impact, and 38% think it will be negatively impactful. So I can't say that's too surprising, and especially our viewers just being Canadian as well. I think you're going to have a negative, no matter how I phrase it, you're going to have negative skewed. But we've talked about this before as well. It's not clear cut because one policy might help, let's say, the service side, the other side might help producers, but so on. Whether you're upstream, downstream oil as well, where he actually implements the drill baby drill policies. Obviously, drill baby drill implies they're going to drill more oil, but whether or not that actually is the case is a big part of this question. But I don't know what your guys' thoughts are.
I think that's pretty much spot on in terms of it's one of many things. So, I mean, if you reduce regulations to the extent that that reduces some costs for the companies to explore and develop, then, that would be overall, at least to the companies, a net positive. I mean, they would essentially be able to develop properties that at a lower cost, at a lower commodity price, right? If their cost of production is going to be lower, but that's to the extent that their costs actually decline, right? Because there's other factors that are going to weigh in, right? So if there's a big tariff war raging globally, then there's going to be higher costs in other areas as well. So it's really a very complicated thing, but ultimately, what's going to drive is demand. Really, if the demand is not there, then companies aren't going to drill, regardless of or to the extent, regardless of what the regulation is, right? Mm-hmm. There needs to be that economic incentive. If we do go into a shakier economic scenario here globally in terms of, maybe a recession, then that would typically result in lower oil prices.
So what I'm getting out of this is the biggest impact Trump's going to have on oil prices isn't the drill baby drill policy. It's going to be tariffs crashing the economy. Is that
potentially if tariffs even happen?
Yeah, initially the energy sector went higher in the U.S. after the Trump win, and then you've quickly seen the market come back. I mean, as people realized, I mean, in theory, if you were able to drill baby drill and you increase the supply, the price goes down. So for those producers, they get to produce more at a lower price, and then there's a natural adjustment in the market. It's a supply and demand. If there's more supply, the price comes down. They stop drilling as much, and so I mean that, I'm not sure how much effect that would really have because it normalizes. They're not going to keep drill baby drill if you kept increasing supply and it went down to 60, 50, you naturally stop because your cost base is higher. And there is, like Aaron said, maybe they reduce the cost base, but it naturally adjusts over time. We've said that. So I would be in the camp in that of it would have little impact over the long term, certainly. It's global forces, supply and demand, that affect energy, not one drill baby drill campaign or some cutting red tape. So initially you saw that positive reaction, and it has fallen right back to basically where it was prior to the confirming the Trump election.
Yeah. And that's the thing, like there are several energy services companies, that we've been watching closely. Like I'll, do a your stock, our take on one today. But it really depends on like the activity in the space. And I know that Ryan had sent over, just some Baker Hughes rig data to us. Just kind of showing that rig activity is now 5.4% below the level of 626 rigs working last year in the US. Of the total U.S. rigs working last year, 488 were drilling for oil, and this is a 3% below last year's level of 503 rigs working. The natural gas rig count is down about 17.5% from last year's 120 rigs, now at 99 rigs. And they note here this decline in drilling and production should continue for a few more months as the industry waits to see Trump's industry support, especially on the regulatory side. Approval of new infrastructure will also be closely watched. And weak WTI prices at this time have slowed energy companies' drilling plans for early 2025. In Canada, there was like a one rig decrease, so not much of a change. But the rig activity rate was above last year's 231 rigs, up, about 5.6%. So, it's just something to keep an eye on for these, energy services companies, especially.
Yes, and we've actually talked to a couple of CEOs from energy service companies over the last couple of weeks, and like one of the things that they see positive demand long term, but in the near term, with the uncertainty around potential tariff wars, there is just a pullback in spending. People, if they want to spend, if they're looking to ink a deal, CapEx project over the next month, they're just going to wait. In the near term, it may wait till next quarter. It may lead to a situation when you get some certainty, if we ever have some certainty, but it may lead to a situation where there's some pent up demand, but it may lead to kind of a depressed quarter coming up in terms of, not the next quarter, because that's a lot of these companies are still reporting their Q4, but into their Q1 and Q2 this year, you may see people just, whether the demand could be there, but if you've got a big project that you can go forward on green light right now, maybe you wait a quarter and just wait till there's more certainty. Am I going to break ground in a new manufacturing facility in Canada, or am I just going to wait 3 months? If it's a 2-3 year project, you probably just wait 3 months, and you're probably going to see some artificially lower numbers because people are just waiting, and then get some certainty, and then maybe some pent up demand in the second half of this year. Of course, if we ever get certainty, but at some point, the new normal becomes an uncertain environment, and companies move forward, and you just say, okay, well, I'm going to deal with this. We're going to put certain precautions in place that will allow us to either have a facility here, or we'll have half there or half there, but they'll have to do something. In the near term, I think capital's frozen up a little bit, and you're hearing that from a number of sectors and a number of CEOs. And I would think that, you could see some weakness. Maybe it'll be interpreted as a huge pullback. It may be just nervous spending, in the near term. So we'll see. There may be some opportunities to buy some companies that get depressed that we know are actually good long-term businesses. And we'll be looking forward to that over the next couple of quarters. So this week, I'm just going to provide kind of a brief update on a company we've looked at on the past, on the show in the past. We've interviewed management as well. Kraken Robotics, symbol PNG on the TSX Venture, trades around 218, 214, $572 million market cap, doesn't pay a dividend. What do? They're a marine technology company providing best-in-class, ultra-high resolution software-centric sonar and sensors, power systems, and underwater robotic systems for military and offshore applications. The company is based in St. John's, Newfoundland, and has operations throughout North America, Western Europe, and Latin America. So the shares are actually down year to date, around 21%, roughly, more following the risk-off trade near term in the Canadian market. But having said that, over the past year, they're up nearly 100%, more indicative of the growth in the business over the past 7 years. And let's take a quick look at the company's most recently released numbers. These are the Q3 fiscal year 2024 numbers. If we see here year to date, I'm going to focus on first. So for the first 9 months of 2024, revenues year to date increased 52% to 63.2 million. Adjusted EBITDA year to date up 64% to 13.7 million. And if we look at net income here, up 117% to 6.4 million from net income of around 3 million in the comparable 9-month period. But the Q3 numbers were softer. Revenues declined 4% in the third quarter to 19.5 million. That the decline year over year in the third quarter occurred as a significant increase in sea power and subsea batteries and service revenue did not offset lower catfish and remote mine disposal system revenue. Adjusted EBITDA declined 6% to 4.1 million from 4.4 million due to slightly lower revenue in that quarter. Adjusted EBITDA margin in the quarter stood at 21.2%, down slightly from 21.7% in the comparable period of the prior quarter. And net income declined 29% to 1.6 million compared to net income of 2.3 million due to higher financing costs related to the credit facility entered in April 2024. This, alongside current market dynamics, has helped push Kraken lower in the near term. Let's just briefly look at this new project that the company came out with here. Essentially, they received a record battery order this week. It's the material power contract that they received and new manufacturing facility that was announced. They received a record battery order this week and clarified details around its new Halifax-based battery manufacturing facility. 34 million in total orders, broken down as around 31 million from one customer and 3 million from two smaller customers. Smaller portions of the orders will be delivered in 2025, with the majority in 2026. The Halifax facility is expected to cost around 10 million. Will be operational by Q4 2025, and the estimate is for it to be able to produce up to 200 million in annual revenue at full capacity. So significant for the company for sure. There's a new class of batteries that has been developed to address small and mid-size unmanned underwater vehicles, or UUVs, like the Remus 100, 300, and 600 platforms, Teledyne, Gavia, L3, the L3 LVR4, and the ST-Eng Mercury, etc. A number of these. Now, while PNG batteries have always been more efficient from an energy density perspective than incumbent batteries, its cost profile was higher given the pressure-tolerant capabilities. PNG has found a way to optimize this such that it can compete and hopefully meaningfully expand its TAM, or total addressable market. So that is the update on its material power contract and the new manufacturing facility just announced. Let's take a quick look, like I said, at the valuations of the company today. If we look at 2025 estimates of adjusted EPS, it trades at around 21.4 times. 2026 adjusted PE is around 12.58. Now, I do see that as a very optimistic estimate that is out there right now. If they can hit that, the company is trading at undervalued valuations currently. Let's look at a conclusion here. Again, this is very basic. The company is a good company with valuations in the near term, however, trading around 21 times this year's expected earnings are fair. If they hit that, what we said was an aggressive earnings target for 2026, then it offers some value. Near term, we monitor for guidance and better potential entry point in the stock as we see volatility in the markets, generally speaking. And the near term, they're doing that build out of the new facility. Okay. That ends your stock, our take on releasing the Kraken.
You know, I would be somewhat concerned here when you have a small microcap growth stock that has been producing such amazing quarterly revenue growth for several quarters consecutively, and then hitting a point where now you actually see revenues pull back, right? So that to me would be a pretty big concern in terms of just where that trend is heading.
Yeah, I mean, it's an interesting business. The long-term revenue growth here is quite strong. You look back to, say, 2020, 12.3 million, then it went to 25.6, 40.9 by 2022, 69.6, trailing 12 months now is about 91.2. So the trajectory and the projection for growth continues with the company, but there is that, the recent pullback, and the market's, a little concerned in the near term, but it does look like, with that battery facility coming online, there is some potential for longer term growth. It is a company that we would look at potentially if we saw a significant pullback. I mean, there has been a share increase over that period as well, which, we monitor closely. If you go back to 2019, there's about 147 million shares out. Now there's 218. So there has been consistent share increases over time to fund some of the growth in the business. But it is a company. Certainly, there's a hell of a lot worse companies out there in the market, and this does have some growth.
It's an interesting company, interesting technology.
Yeah, it certainly is, and they're servicing the defense market where we believe we're going to see some further spending increases. So it is interesting play in that area. So we are monitoring it closely. It may be a company that we can look back at pullbacks and look at on pullbacks to take advantage of. All right, well, we can move on to our next segment. I believe Aaron has a Your Stock, Our Take, and that is on Highliner Foods. Aye, Captain. Take it away. Captain Highliner. Fish sticks.
With pleasure. Okay, so
Captain Highliner got more attractive recently, I think.
He did.
Like, what happened there?
wasn't-
Remember that guy that used to be?
He looked
This
a little
guy.
more weathered back when I was a kid, but somehow, I guess this is his son, maybe.
Yeah.
That's like
You're born looking kind of just the silver fox look.
Yeah. Somewhat of an iconic company, I think, at
Yeah.
least for me. I mean, I
Mhm.
ate lots of Highliner food, and they seemed to do a lot of marketing when I was a kid too. So it was a well-known brand, but also a publicly traded company, and a company that we actually had coverage on at Keystone several years back. I think we picked up coverage maybe around 2010 and sold it around maybe the 2012, 2013 timeframe. But let's take a look at them today, because they've come out with a couple interesting quarters here that are worth some analysis. What they are, they're a leading North American processor and marketer of frozen seafood products. This is for the retail and food service markets. Food service primarily meaning restaurants. So when I talk about it being an iconic brand, I'm thinking about those breaded frozen fish sticks with the Captain Highliner logo smiling back at you. But they also, most of their business is actually selling into the wholesale market to restaurant and food service. So trades under the symbol HLF at about $16.50 right now. It's a 500 million market cap company just below, and it also pays a nice yield of just over 4%. So when we take a look at the company's recent performance, we can see a pretty nice bump here from November of last year. Stock moving up after the company released its Q3 2024 results. Now, these results were a little bit mixed, so it's interesting to see how the market responded to them. So revenue was actually down 12% in the third quarter, but adjusted EPS up 43%. So we're going to look at that in a few seconds here in relation to the recently reported fourth quarter. Now, if we look longer term, if we go way back, this company's been around for a while as a public company, much longer even just as an operating business. But really, it's been a wild ride for shareholders. As I'd said, we got out of the company, I believe, around that 2012, 2013 timeframe. So we avoided a lot of this volatility, but it does look like the company has started to perform a little bit better, at least on some metrics recently. So looking at the company, just breaking it down by geography, 78% of the company's sales are to the US, 22% to Canada. And then when you break it down by channel, 32% retail. So that's like you go into your grocery store, you see their products and you buy them at the cashier. 68% food service, which is that wholesale business. So diversified throughout North America, but weighted towards the US. Now, let's take a look at the recent quarter that was released, Q4 2024, and the full year results. Now, if we look at sales for the quarter, they were actually lower for the quarter and the year. So 235 million in the quarter, down just slightly, really just flat from 237 million. We did see a nice little uptick in gross profit margin, 21.7%. in the recent quarter compared to 20.5%. And then adjusted EBITDA, about 8.8% growth to 23.7 million, and a little bit of an uptick in the margin there. But then when we look at adjusted EPS, 41 cents compared to 23 cents. So quite an increase there, almost a double, in spite of adjusted EBITDA only moving up in the single digits. Now, the first thing we're going to look at here is just the weighted average share count. So we can see that it had come down quite a bit, actually, about 10% in the quarter compared to the previous year. So 30 million shares compared to about 33.8 million a year ago. Now, what is the reason for this? Well, these are share buybacks. The company's producing a lot of free cash flow. It needs a place to put that, and it believes that it had believed that its own stock was the best investment of that capital. So it purchased shares, canceled them. You're seeing the share count decline, and that is one of the things that's pushing the earnings up. But there are a few other drivers as well to the positive performance on the bottom line there, the differential between adjusted EBITDA and earnings per share. So there was lower depreciation and amortization. That's a non-cash expense, so I won't focus too much on that. But also lower underlying interest expense. So the company has been reducing its debt. It paid out about 21 million in interest for 2024. Which was about 5 million lower than what it paid in the previous year. So it got good uplift from that. And then also those share buybacks, reducing the share count. So this is really a combination of a number of different levers here. You had the positive adjusted EBITDA, you had the improvement in interest expense, and then also the lower share count. Looking at the balance sheet as well, as I said, the company's been reducing its debt. So debt has decline in terms of leverage ratio, about 2.3 times on a net debt to EBITDA basis compared to 2.6 times a year ago. And then based on valuation, it's trading at about 11 times earnings right now, based on that 16.50 share price and adjusted EPS for 2024 of $1.51. Now, there aren't many analysts that are covering the stock, so there's no use of looking at analyst estimates. We're really just looking back at the trailing earnings per share. In terms of what the management's outlook is, they do have a cautiously positive outlook going into 2025. They think that they're going to benefit from volume growth. They also think that they are well positioned to do acquisitions, but there are some headwinds in their market as well that have impacted volumes, and that's why we've seen the lower revenues. So I think that having a fairly conservative or realistic projection in terms of what the growth will be going forward would be wise. And I wouldn't be expecting another 50% plus increase in earnings per share going into 2025. So our take on Highliner Foods, they do appear to offer good value. We like the business. I mean, I actually have a bag of Highliner fish sticks in my freezer right now. And it is very encouraging to see the strong earnings growth. So one of the things that I'm going to say about Highliner here, and this is just really my own speculation, but I really see this as being a company where there's a high potential for it to be bought out or privatized, hopefully at a significant or meaningful premium to their existing shareholders. Why do I say this? Well, one of the reasons is that, it's been around for a while. As I said, it's an iconic brand. I don't think that it's going anywhere. Consistently profitable, but not necessarily well suited for the public markets, because it's not a company that produces consistent levels of growth from year to year. So the valuation has been depressed for a while. Right now trading about 11 times earnings, not extremely depressed, but certainly I would still say at a discount relative to its underlying fundamentals. Yet it is a big free cash flow generator, reasonable leverage on the balance sheet, and I just think that that's a mix for somebody wanting to basically take this thing private or acquire it at some time if they are willing to. So it is a family company, so it is largely still owned by the original founding family, I believe. So if there was going to be a privatization transaction, I would imagine it would be them. Again, hopefully that would be at a good premium to the existing shareholders. But really the market, though, in terms of their end markets, they are facing a number of headwinds. As I noted, revenues have not been growing recently. So we are seeing strong earnings growth from some improved margins, lower interest, and then lower share count. But that's not necessarily a sustainable long-term growth strategy, we would like to see some strengthening in the volumes and in the revenues. There's also the potential tariff-related risks with the U.S., specifically Highliner. As I said, 76% of revenue in the U.S., and they produce a lot of their product in China. So it would be primarily the tariffs between China and the U.S. that would impact them. But we do think that the fundamentals are quite strong. So from a value perspective, it does look like a good company long term. We're not ready to go out right now and make any recommendation on it, but we are in the midst of our research for our 2025 Canadian Dividend All-Star Report. Right now, it's up at the top of the list in terms of further research. So that report should be out before too long. I don't have an exact date, but when it is out, there could be a recommendation in there, or perhaps not. We'll continue to monitor. All right. Any comments?
Yeah, so I think one of the biggest shifts you did highlight that the leverage going down for net debt to EBITDA, but also just they've previously had, and I think they still do, is primarily floating debt. So just the general interest rate structure for the entire market going down has been helping them as well, which is obviously a great positive for them. Because that was, I believe last time you did a segment, at least for the podcast for them, was that high leverage, I think around 4 times. And that has brought down, the actual payments have brought down. And that's really just been so accretive to their bottom line. And I think previously, when you looked at them before, they were being impaired by that high inflation at the time. So this was a year and a half ago, 2 years ago now.
Yeah, it was. Yeah. And that is one of the things that I've noted about them, is that they have in the past had trouble passing on higher costs to their customers. So they don't have the greatest pricing power there. They have been able to pass on some costs at times, but that is often a headwind for them.
Yeah, and it's a good point on the lower, like the floating debt coming down and certainly improving their profitability. For sure. It's certainly a company we monitor. Let's move on to Brett's third. This is our third Your Stock, Our Take. We have 4 this week. It is certainly a topical company, Him and Her Health symbol. The symbol here, Him and Her Health, the symbol is just HIMS, HIMS, on the New York Stock Exchange.
Yeah, so like Ryan said, I've seen it for probably the past 6 months to a year online, effectively any place which stocks are discussed quite constantly. It's been very topical. So, and they've had a big change over the past couple of weeks. So we'll look into that. But if you're unaware, Hims and Hers Health, symbol HIMS or HIMS on the New York Stock Exchange, operates a telehealth platform that connects consumers to licensed professionals. The company offers a curated range of prescription and non-prescription products on a subscription basis with a focus on personalized healthcare. The company serves 4 core specialties: sexual health, dermatology, mental health, and the topical one being weight loss. As a whole, since the launch since 2017, the company has really staged itself as a disruptor of the traditional pharmaceutical and healthcare business as a whole, and they now service actually over 2 million subscribers. So it's really been that growth story to that subscriber count over the past couple of years. So if you want to liken them to another industry, it's that Uber disruptor model, high growth rate at a lower cost, and really that consumer focused mentality for at least their past 7-year history. But the stock has performed extremely well over the past year, up 187% to 42.17 at the time of writing, and that comes out to $9 billion in market cap. Despite they have fallen recently from its all-time high of a whopping $73 after the company aired a very well-received Super Bowl ad. For the most part, at least as far as the stock price goes, there were actually some criticism behind the scenes, which I'm not going to get into. But the stock fell recently due to the removal of GLP-1 drugs from the FDA shortage list. The branded versions of GLP-1 drugs include Ozempic and Wegovy, with the active ingredient being semaglutide. The company has offered compounded semaglutide since May of 2024 with accelerated growth for high demand, but in short supply treatment. But now that has changed, with the FDA now removing on February 21st from this the semaglutide from its short supply list, which corresponds with that large drop in the stock price by about 50% the day after, or the couple days after, I should say. Effectively, this means Hims will no longer be able to offer the GLP-1 copy drugs in the near future, with the company stating that semaglutide is not to be offered on the platform after Q1. But they said also as well, if it does go back on the list, or if they can legally offer the compounded variants of the drugs, they will. But at this time, that doesn't look to be the case. And this wasn't actually unexpected. People expected it to be removed off the short supply list. That is expected whenever something does go on the short supply list. Once supply comes back on, it gets removed. And that was a major growth driver within 2024. It really was only just 2024 for it. It wasn't 2023. HIMS itself brought it, the GLP-1 copy on to their platform in 2024. But it was really that big boost in 2024 that it provided, that the GLP-1 provided. And it was expected really that party then, just not exactly when for the GLP-1 drugs. Further, the other concern I would really have is their reduced ability to cross-sell going forward, as the cheap GLP-1 offerings, which it was about $165 once they, at the most recent offering time, it came on at, I think, $199 onto their platform, but they're no longer offered on the case, compared to Ozempic being around $1,300 on a monthly basis. So $1,300 compared to even less than $200. That's a big difference. And that was really the big selling point of their compounded drugs, is just how much cheaper it was compared to the branded variant. And they're no longer able to do that. The company is, however, expected to, and they are still expecting to offer their oral-based weight loss solutions, as well as generic liraglutide later this year, which is a daily injectable instead of weekly, and generally has been less effective than semaglutide. But the trade-off is that it's still going to be a couple $100 a month compared to the well over 1,000 the branded semaglutides. So your trade-off is less effective, but at a fraction of the cost effectively, and it's not as convenient as you do have to do daily injectables compared to weekly. So it's not as consumer friendly as it previously was with the compounded semaglutides. Switching pace to the most recent financials reported on February 24th, so a few days after the shortage removal. For the year, the highlighted operational metrics: subscriber count grew 45% to 2.2 million. Monthly average revenue per subscriber grew 38% to 73%. Net orders increased by 22% to 2.8 million from 2.3 million, with average order value rising 63% to $168. High growth across the board, but the average revenues per subscriber will be a bit elevated compared to likely the future, as the semaglutides are more expensive than the company's other offerings, which are normally $35 to $55. So, and then the other aspect that actually did increase that in HIMS' favor was the increased amount of personalized treatments, which does come at a premium. But going forward, you will likely see that drop down as the semaglutide craze, which they can no longer offer, will lower their average selling price as well as their average revenue per subscriber. So for the year, the company's revenue grew by 69% to 1.5 billion from 872 million. And when excluding GLP-1 offerings, revenue grew by 43% to 1.2 billion. So still great growth, but just not as great growth once you remove that impact. Gross margins came in at 79% compared to 82% in the prior year, primarily due to the GLP-1 drugs being priced strategically to attract customers. And that really comes into my previous statement of that cross-selling could drop, because they were really using it as a halo product more than anything, as well as it was profitable, I should say. Adjusted EBITDA grew substantially to 177 million from 50 million, with an improved margin of 12% compared to 6%. The company posted its first year of GAAP profitability, with all 4 quarters being GAAP profitable, with 53 cents per diluted share compared to a loss of 11 cents in the prior year. Similarly, free cash flow also grew substantially to 198 million from 47 million. Overall, a very strong year, and that's been well reflected in the stock price. The balance sheet as well, very strong. Cash and short-term investments of 300 million, and only minor lease liabilities with no other substantial debt. So great balance sheet at this time, no debt, and they've been using it to acquire some additional companies and facilities. Shifting to guidance for 2025, the company expects revenue of 2.3 to 2.4 billion, implying growth of 56 to 63%, with adjusted EBITDA of 270 to 320 million, 12 to 13% EBITDA margin. The guidance does not include any commercial offerings of semaglutide. So whatever amount they are able to sell within the year, it's not included in this. So there is actually potential upside to the guidance if they either have great Q1 sales or down the line if it goes back on the shortage list or some variation of that. So far, I've been pretty positive on the company's operations, but let's take a look at the valuations. Using the company's midpoint guidance, the stock trades an EV/EBITDA on a forward basis of 29.5 times and a price to sale of 3.8 times. So a premium valuation, even with the high growth continued to be forecasted. The company has a target of 10 million subscribers over the next 5 to 6 years, and the current valuation really puts weight on that target. If you do a discounted cash flow and stretch out, which is a stretched out variant of a ratio, you can see that it does rely on having these high 30-40% growth rates being continued for the next decade, really. So concluding, this is really that classic growth stock scenario of where it does still have strong underlying operations with this in respect to its historic growth, but the main bull-bear diversion or division, that is the word I am looking for, is if growth can continue at such a high rate. The stock is traded at a premium and continues to be, but is this premium overstating the growth prospects going forward? I would say that the company at the current price does not offer really a margin of safety. Yes, the company does have the liraglutide products, but also you're likely going to see some GLP-1 users not willing to switch. Some will, but some won't. They won't want to do the daily injectables, and they are willing to pony up the $1,000 or $1,300 a month. Some of them will want to just stay on the $200, which isn't as effective, but we'll have to see really how that affects. And then the other aspect is the degree of the halo effect, which the GLP-1 treatment really was bringing in. That Super Bowl rush in the stock price, you saw that people really putting weight on it being a weight loss halo product. Now, is that going to be the case going forward with the entire platform? Are they going to be able to cross-sell with the alternatives? Maybe not, maybe so. We'll really have to wait and see. So at the end of the day, we are GARP investors, growth and reasonable price investors. And while HIMS may have the growth, it doesn't really seem to have that reasonable price at this time. It doesn't offer enough margin of safety. So we will continue to monitor the company going forward.
Yeah, I think it's a good point. It probably has to continue to grow at 30% plus there, going forward for at least 3 to 5 years to justify the valuation. The other thing that I would point out there, and I think you already did point it out, is the margin, adjusted EBITDA margin is, 12% or so, 11, 12%. So it's not a high margin there. And I wouldn't expect it to ever be. It doesn't mean we can't invest in it. It does have it has a solid balance sheet, and it does have the ability to grow sales over the long term. It just has to grow those sales. It has to be at a high rate. And if anything, hits that, as you can see, you had a little nick in the long-term or the long-term growth prospects with the GLP-1 situation, then it gets hit hard. So it may get hit hard and come down to a range where you're looking at it and saying, oh, this is growth, yes, which it is now, and it may become a more reasonable price, and then maybe we could be a buyer of a company like that. But at this point, it's growth, but the price isn't reasonable enough for us to take a stab and invest in the company at this point.
Yeah, and on that margin point, I do believe management is expecting margins to improve to, I think, between 20 and 30% over the long term. But that's decade.
That would be a lot better.
Yeah,
that would be a lot better if you could get to that.
Yeah. Incorporated in these high valuations at this time. And that's the whole bull case of it is you still have that 30-40% revenue growth, and then you get that margin as well.
And that's still have to actually do that.
Exactly. You still
if you could get that,
if they don't achieve it,
if you get a reasonable price growth and an uptick of margins over time, like going from 11% to 20 plus, like if you could do that over the long term, you'd have earnings growth from organic revenue growth, and then you'd also have a margin uptick that can provide earnings growth, and you'd probably, you can sustain a higher margin on the stock. But right now it's pricing all of that in. Certainly when it was at $70, it's pricing everything in to perfection. That doesn't give you any margin of safety. And it's that combination is too high risk it may be a company that we look at. If this is a weaker market over the next 6 months to a year, there can be some, companies that you see long-term growth in that you may want to buy, and it could be half the price or less that it is today, and that may be a time to buy.
Yeah, and just even going back just on the stock price volatility, if you just go back to the start of the year, it was $26. That's still a 30% discount from where it's at. And if anything, with the GLP-1 scenario, is really the outlook in the short term, at least over the next year, is decreased.
Yeah.
So
So
it's a
it could be
volatile
there.
stock is my point.
It wouldn't be, it doesn't say it's going to go there, but it could be there. So you put it on your monitor list and you have a valuation that you think is the intrinsic value going forward. And that's what we'd be doing. If it goes significantly below what we think intrinsic value is, then it could be a buy. And we have a US small cap related service that this would kind of fit in there, roughly in that category, that we would then look at for inclusion there. It's dropped below the $10 million market cap, so it's $9 million. If it comes down significantly, it's kind of in our wheelhouse, and it may be a company that we'd look at. It doesn't have the margin of safety in terms of valuations right now that we'd like to see. All right, let us move on. Last and certainly not least, Brennan, since you're feeling bad with that migraine, let's say not least.
Last but
Enterprise
least.
Group.
Yeah, I'm going to be a little less enthusiastic today than I usually am, but I'll try to pump it up, pump it up. Okay. So Enterprise Group. This, I guess I'll share my screen here. This comes in from idea. Ed. He is a client, and when I took the question from him, I wrote down he is also a fellow Oilers fan. So go Oilers. I know Ryan loves hearing that. So this is a company we've monitored for quite some time and interviewed management back in September 2024 in Vancouver. So we spoke with them not too long ago. Now, Enterprise Group Inc., ticker symbol E on the TSX, currently trading at a price of about $1.98 today. I believe it was actually down in the trading session, but that's just what I have here. I think it was down maybe about 10% or 8% today. The market cap is about $163 million. And they provide specialized equipment and services in the build-out of infrastructure for the energy, pipeline, and infrastructure construction industries. They primarily have a presence across Western Canada with a concentration in Alberta and northeastern British Columbia. And their businesses include Hart Oilfield Rentals, which is a full-service oilfield site service infrastructure company, including fuel, generator, light stand, sewage treatment, medic, security, and truck trailer combos. They also have Westar Oilfield Rentals, which is also a oilfield site service infrastructure company. They have their Arctic Therm, which provides flameless heaters. And then also Evolution Power Projects, which is their newest acquisition, which provides low emission nat gas powered systems and microgrid technology, allowing clients to eliminate diesel generators entirely. So the stock has had a strong year, up about 130%, driven by excellent financial results, which Aaron discussed back in May of 2024 when we covered the stock on the podcast last. And with both the fiscal year 2023 and Q1 2024 financial results driving the stock higher. And up on the screen here, these results here are what Aaron went over at that time. But as Aaron discussed back in May of 2024, when we covered the stock on the podcast, energy service companies can be very volatile, as shown by the company's long-term historical stock performance, where the stock took a drastic decline in 2014 and 2015 when we saw energy prices decline. Now, looking at the most recent financial results, which were for Q3 of 2024, ended September 30th of 2024, revenue was $6.8 million, a decrease of about 24% from the same quarter last year. And management noted that for the first 9 months of fiscal year 2024, they saw an increase in activity levels. However, Q3 saw a reduction in activity, with management attributing it to number one, apprehension and preparation for a potentially severe forest fire season, leading some customers to delay the execution of planned projects to the end of the forest fire season. And number two, some customers took advantage of summer months to allow employees extended time off to prepare for busy times ahead. And even though Q3 saw reduced activity, general activity levels are higher than in 2023, and management expects increased activity to continue throughout the remainder of 2024 and into 2025. Now, given the reduction in revenue, gross margin was down 37%, or down to 37%, from about a gross margin of 46% in Q3 of 2023. Adjusted EBITDA declined 47% to 1.8 million, and net income was a loss of 200,000 for the quarter, compared to a gain of 1.6 million for the same period last year. And just quickly looking at the balance sheet here, the company has about 8.1 million in cash. Debt and leases were 27.6 million, providing a net debt position of about 19.5 million, or a trailing net debt to EBITDA multiple of about 1.3 times, which I wouldn't say is bad or overly concerning. But as listeners know, we would certainly prefer the company to be in a net cash position, especially considering the cyclical nature of the business. But I also need to mention that the company did issue 15 million shares at a price of $1.90 per share in December of 2024, which provided the company gross proceeds of 28.8 million and should place the company back in a net cash position. And the company plans to use the funds for continued expansion plans as well as for general working capital. And this follows their previous financing of 8 million shares at a price of 85 cents for gross proceeds of 7 million in March of 2024. And I believe that after the most recent issuance in December here is getting the company up to an outstanding share balance of approximately 77 million shares outstanding. Now, quickly looking at the valuations, the company is trading with a trailing price to earnings multiple of about 15 times, price to cash flow of about 11 times, and an enterprise value to EBITDA multiple of about 12 times. And this compares to a trailing valuation of about 9 times earnings and 6 times EBITDA when Dunn covered them last in May. So the valuation multiples have been increasing, clearly, given the weaker Q3 earnings. So it's probably good to, see the company issuing shares at higher levels in the $1.90 range while, the valuations are, elevated a little bit more. But again, when we are looking at the valuation of a microcap oil and gas services company, we would expect to see lower valuations, like typically, below 10 times earnings or around 10 times earnings. But of course, this is all conditional on, the growth level and visibility of the growth. And growth has clearly, been very strong over the past 3 years. But again, we're dealing with a cyclical business. We would want to see, this cyclicality kind of shown in the valuation. So, I would say that at this point, the valuation is maybe more on the higher side when looking at the trailing results, given the recent weaker Q3, which management believes is somewhat one-off. But there could be some uncertainty looking forward, given the oil and gas tariffs, which could further delay some investment activities in the sector. Now, another piece of recent news that I would like to just quickly highlight is that Enterprise announced an exclusive agreement with Flex Energy Solutions, which is a global OEM manufacturer of microturbine power generation equipment, which places Evolution Power as the sole provider of short-term turbine and microturbine applications across all commercial and industrial sectors in Alberta and BC. So under the 5-year agreement, Evolution will exclusively provide its turbines and will help customers go from diesel generators to more efficient nat gas generators. And when we spoke with management in September, they told us that the flex turbine generators are much more effective or efficient in cold temperatures. So they believe that it is a significant advantage that they signed this deal. And as well, they also noted that they have about 15% market penetration of current sites that they could be in with their nat gas turbines. So they think that they have a good runway to grow this to, about 66% penetration over the next few years. So this is essentially, the runway of growth that they believe is ahead of them beyond, just the current typical demand from the Canadian oil and gas sector. So to conclude here, Now, in 2018, Enterprise Group transitioned to move from diesel generators toward nat gas generators. Management considers themselves to be the leader of low emission electrification systems in Canada, and this was recently bolstered by their exclusive 5-year agreement with Flex Energy. And they noted that there is competition in the U.S. for these types of turbines, but not so much in the Canadian market. Now, the company has produced strong growth over the past 3 years with strong trajectory in revenue and margins. Gross margins have been increasing, due to less need for field techs. Management has stated, given a lot of switch to nat gas generators. Q3 2024 was weaker, which management expected, due to fires in the summer of 2024. And management believes activity in the space to remain high throughout the rest of fiscal year 2024 and into fiscal year 2025. The balance sheet is healthy and should be back into a net cash position following the December 2024 equity issuance. In September, management noted that they would like to get back into a net cash balance sheet to maintain growth. And really, I don't love seeing the dilution, as it will, evidently make it harder to grow per share earnings. But at least the company was issuing shares at higher valuations. Now, the trailing valuation multiples are not cheap, in my opinion, at about 15 times EPS and 12 times EBITDA. But again, this was due to the weaker Q3, which was expected. So the forward valuations may look better. But I'd really like to keep a close eye on, the demand and activity in the sector, over the next few quarters here. Now, overall, I think it's an intriguing business with a runway of growth and attractive fundamentals driven by an upswing in the energy patch over the past few years. But my biggest concern is whether, that growth can continue in a space that has been historically cyclical, and whether companies, will be putting off investment decisions given tariff uncertainties, which could impact the business's recent acceleration in growth. Certainly a name that we will continue to monitor, though, very closely, and I'm sure that we will be speaking with management in the near future to get an update on the business. And here's a disclosure: we do not own the business.
Yeah, I think it's a good summary, and really what you're just saying there is with the uncertainty in the capex spending generally in Canada right now. I think you just wait on a company like that, see if you can get a more attractive entry point. I mean, that is on top of the fact that this company and anybody in the energy sector is cyclical in any market, and we have another layer of risk that's layered on top of us in terms of uncertainty in the near term. Just waiting. We're interviewing a number of these companies now. We think there's some value in these businesses long term. If we can get them at significantly lower prices, it may be something we look at. But when you're not trading at a depressed multiple and you have uncertainty, it's something that we'd be wary of in the near term.
Yeah.
And we'll track their quarters as they come out over the next 6 months to a year. I think that's going to end off our show this week. Nobody had anything else to add? Correct. Okay. Well, we've got some news in the coming weeks about some upcoming, our first webinars, we call them our spring webinars, but they're really just our first webinars of 2025. We'll have some news on that over the next couple of podcasts. In the near term, if you are watching this right now on YouTube, smash that subscribe button. If you're listening to this wherever you consume your podcast, rate and review us. And as always, I'd like to wish you profitable investing. Thank you.
Thank you.
Thanks, everyone.
Thank you.